Hey everybody.
Hello, hello. How's everybody doing tonight?
So we want to make this as interactive as possible. So please feel free to add your questions in the
Hey
chat.
everybody. Hello, hello. How's everybody doing tonight?
So we want to make this as interactive as possible. So please. Okay, so we are going to go ahead and get started. Little technical difficulties there. So we're going to go ahead and get started, everyone. So here we go. Sorry. All right. All right. So welcome to the Q&A session. We're going to go ahead and get started. So tune in, please. We invite everybody to please close your tabs, put your phone on silent if possible, grab a pen and paper. And if you stay until the end of the presentation, we have something very special for all our viewers. So please stay tuned.
Please.
All right. So we'll go ahead and get into it. You see our logos. So
Right.
we're so official.
We are official.
By the
Let's
way.
see. There we go. There we go. I remember the camera's reversed.
All right. So meet the founders.
So I'm John Clark. I have a background in accounting, and I've been doing real estate since 2006. Sounds like a very long time ago. But yeah, I've been doing real estate since 2006. Have invested in many different types of properties, condos, townhouses, single family homes, and I've done some renting. I've done a flip, and have just pretty much trying to get my feet wet with everything in real estate. So that's a little bit about me.
Okay, I'm Joshua Gray. I have a background in electrical engineering. I've been investing in real estate since 2013. I have 8 years of professional sales experience, an MBA, and I'm my HOA president back in my own subdivision. So that's our experiences within real estate. So going back to our presentation here, just thanks for bearing with us. We're working through new technologies.
Right.
So our mission statement.
So we strive to provide a clean and safe housing for marginalized communities while improving underfunded areas by building socially responsible real estate network.
Okay. So our agenda today is going to be a fairly short agenda. We basically have two parts how we want to do this presentation. The first part is we're going to talk about real estate investing. And then the second part is to be counter gentrification strategies. So we'll get into some definitions and a little more of that later. So I see some questions come in. Thanks for the questions. We're going to try to get to as many as the questions or try to work them into the presentation, but please continue to ask your questions. Right now we have live access to our Facebook stream. So if you're watching this presentation on Instagram, we're going to switch over and try to get those questions and come back. So just bear with us. So thank you all for working with us. So we'll go ahead and get into the presentation. So the first section is real estate investing. First question we have is, what is the process of real estate investing?
So basically, the process overall for most people, if you're trying to buy a single family home or just trying to find a home for yourself, basically what you need to do is, you find yourself a realtor, that you can trust and someone that's going to be honest with you. From there, you will get with your bank of your choice and
Okay, can you all hear us now? Are we good now? Are we good now, everyone? Okay. Still no sound. Okay, all right. Let's see. Let's see. Yes, okay, we're back. Okay, awesome. Thank you.
Great.
All right, so I think you left off, you were talking about after you find your dream home, what's the process?
After you find your dream home, basically make an offer. Make an offer once you find your dream home, and basically, hopefully you can get with your real estate agent and you can structure a deal that's very strategic so that your deal will get noticed. Once you make an offer, your offer is accepted. The next step is to get a home inspection. Home inspections are very important when you're talking about making one of the biggest purchases of your life. Make sure that you get a good home inspector and that home inspector is very thorough when they do their inspection, and make sure when you get the report, because the report is very long, make sure that you go through it and see everything that they pointed out and make sure you're comfortable with moving forward based off of what that report says.
So one thing probably want to add that's probably not on this graphic is even before you really find sorry, so everybody who's on the YouTube link, we're going live on Facebook right now. So if you could share the link to the Facebook, we'll pop it in the chat here real quick. Thanks for working with us, everybody.
Yep. Thank you for your patience.
I'm putting the link in the chat now. So anybody who tried to go to YouTube, there's a Facebook link. Okay. So one thing we will add to this diagram that's not here is there are first-time home buying workshops. We really encourage everybody to try to find one. Your realtor can usually tell you what it is. So basically, it's before the coronavirus, it was an 8-hour event where you actually would, it'd be a series of speakers. So everybody from real estate agents to appraisers,
correct,
to anybody related to the home buying process, they would be there. So there was a time you could ask all the questions. And another good benefit of these sessions was that they would usually provide any local housing authority grants. So most of the time, the city of Atlanta has programs,
down payment assistance,
the counties. Really, there's some programs or grants for even if living within a certain zip code or on a certain street.
Correct.
So definitely check those out when you get into that. So we will move on into the next question. Transitioning.
So what are the benefits of getting an appraisal? First off, basically an appraisal is a unbiased estimate of the true fair market value of what the home is worth. So basically appraisal comes out and they assess your home to see what the value is worth based off of recent homes that have sold in the area, the condition of your home. It's a lot of different factors that go into place. So a lot of people, appraisals are very important because they tell the true market value at the time. So I actually encourage people to get appraisals done. Even if you're doing updates to your house, as soon as you're done doing updates, make sure that you get an appraisal done before you start using the updates that you've done, because it's going to give you the best market value for the house. And you can take that appraisal and go to the bank. You can actually borrow off of it if it's more than what your house is worth.
So depending on what side of the market you're on, so if you're selling, you can get a reasonable top dollar and it's worth to get an appraisal. If you're buying, you can get a fair market price, so reasonable price. So that's a good way to safeguard potential buyers or first-time home buyers from not overpaying. But there is one thing to keep in mind. So this is one thing I know for me personally, I learned this when I attended my first-time home buying workshop. Appraisals vary by the appraiser. So this is it's kind of an independent sort of career field. So it's not a one size fits all. One person might say, hey, this house is worth, I don't know, $200,000. Another person say, no, this house is only worth $150,000, and so on and so on. So It's definitely worth, you can definitely shop around appraisers, but that goes back to like the first time buying workshops. They often invite appraisers there, so you get to ask them questions, or you get to understand a little bit more about how to, I don't know, if you're trying to sell your house, how to get the most reasonable investment for it. So we already know top selling features are
kitchens and bathrooms. And basically, even if, whenever you have someone coming out to appraise your house, just make sure that, at the minimum, make sure that the house is in good condition and clean and clutter free, because like Josh said, the appraisals vary depending on who comes out. So you just never know what they're thinking or what they're really looking at. So it's just best to just do your due diligence and make sure that you have your house in the top condition for someone to come and review it.
We got a good comment that came in. First time home buying workshops can be found on the Invest Atlanta webpage. So if you don't know about Invest Atlanta, it's an awesome resource. Highly encourage anyone to check it out. The information is free to the public.
Correct.
So we'll go ahead and go on to the next question. So the next question is, what is the average revenue needed to start investing? So honestly, this is really a personal question. It's really, how much are you trying to achieve? Like, how much are you willing to spend? There's different avenues to go about. If you're buying your first home, you might want to spend something, I don't know, depending on where you are in life, right?
Correct.
Some people look at it, I can move into this, I can pay, this set amount of money, and over time I can add additions, I can increase the value, I can rent it out and then move on to another property. Don't want to sell. You want to buy and hold, at least on your first property. Just FYI in this market.
Definitely.
Part two of that, the best way to know what you can afford is to get a pre-approval letter. So that goes back into what John was initially saying about the home buying process. It's very important to have an idea. So, you reach out to potential, lenders. And
right.
Quick tip on this point, if you're worried about it hitting your credit score, you have a 30-day window.
You have a 60-day
60-day window. You have a 60-day window to kind of do your due diligence.
And shop around with different creditors, and it will not, each creditor that pulls your credit report within that window, it will not show up on your report multiple times like that.
Yeah. So the best way of doing it is, like I said, shop around.
Yep.
And feel free to go to credit unions. So credit unions will probably give you the best rates, bar none. So if you have access to a credit union, definitely utilize them, especially any smaller banks, anything like that. They're usually more willing to lead at lower interest rates opposed to your bigger banks.
Correct. And back to what Josh was initially saying about it being pretty much a personal question, based on what type of investing you're trying to do. If you're trying to buy for yourself, there's plenty of options with the 3.5% down payment through FHA. You get all kind of different down payment assistance through different, through locally funded bonds and grants that local cities offer. But then if you're trying to do an investment property, that's a different type of loan. And basically with investment properties, you have to put between 20 and 25% down as a down payment, because they want to know, since it's not your primary residence, they want to make sure that you're invested in this property to make sure that you're going to do right by it and pay it off and things like that. So it just depends on what you're trying to achieve at the moment.
Okay. Next question. Again, please feel free to add your questions and comments to the chat. We want to make sure everyone's as engaged. So if we miss saying something, if you have additional follow-up questions, please let us know. So the next question is, what should my credit score be to start investing? So we actually have a little graphic here. I'm just going to pop this guy up here. And I hit the wrong thing. And I hit the wrong thing once again.
New technology.
New technology. New technology. Just work with us, please.
There we go.
Here we go. And I'm going to hide this guy.
There we go. So yeah, so basically, you can start getting you can get a home with a credit score of 580. You're able to get a 3.5% down FHA loan with that credit score. Now there are other factors besides your credit score, of course, that goes into getting that goes into getting a mortgage, but the credit score at a minimum can be 580.
So just keep in mind with this that there are multiple ways to go about uh, improving your credit score in the short term that you want to. So one of those ways, so these are just ways, things that we know about. One way is you can pull your credit report for free. So first off, you want to make sure you understand what accounts are open on your credit report, because again, this is something that when the banks pull that information, they have access to it. So you might as well know about it as well. Part two of that is you want to pay off any high interest accounts. So I know a lot of us are, most first time home buyers now, your biggest account right now will probably be your student loans, right?
Right.
So, definitely investigate, do your research to see if there are any things you can do as far as kind of consolidating that debt or at least paying lower interest, because that's really key. Another service that I tell people all the time about and is Experian Boost. So Experian Boost is you get credit for whenever you pay your utility bills or like your phone bill. So it's a free service. So definitely, do a Google search, Experian Boost, but it's free to try and it's easy. You can raise your credit score off in within a one cycle.
Nice.
The other thing is credit card balance transfer. So John actually put me onto this, so you can speak about it.
So with credit card balance transfers, you know how most credit cards you're carrying, they have interest rates on them. But most times, if you do your research, you will find that a lot of credit card companies, they will offer you a 0% interest rate on a credit card for 12 months, 18 months, sometimes even 24 months. And they'll allow you to transfer your credit balance from your credit card that you are currently paying interest on over to the other credit card and be able to just pay a principal balance for whatever that period is that they're giving you 0% interest. This helps a lot because it allows you to just put money straight towards the principal and not have to pay any interest. So it helps you pay down that debt a lot faster, as opposed to keeping that credit card with the same company that originally started with and just paying a lot of interest on it when that could be going to your principal.
Okay. See some additional questions. I'm going to try to work this one in. It says,
Ian.
Yeah, Ian says, where do you suggest getting your credit score? Freecreditreport.com. I think you're allowed to get, quote me?
One per year. One free credit report from all three bureaus per year.
So you're by law, you're able to get that one report. I know if my financial advisor is watching this, I know she's going to be like, what? I use Credit Karma.
You have to be careful with Credit Karma, but go ahead, finish your statement.
So Credit Karma is it like it only gives you access to 2, and of course there's a drop period, but it's a nice way to kind of see when things drop off your credit report or when new accounts open. You usually get an alert. It says, hey, this has been added to your account, or when you pay down stuff as well. So I think it's a good quick and dirty
it's a good service for those reasons, to see what's coming on and falling off, where you can constantly watch that throughout the year. It's not very accurate a lot of times when it comes to your actual credit score.
Right.
Those scores, I've had a variance of like 50, 60 points based off of what actual like Equifax says versus what Credit Karma says. So don't rely on it for your scores, but you can rely on it for more so for, like you said, with making sure that what's new popping up on your credit report, they will report that stuff.
I would think it's better for like the short term, like maybe alerts. Like I'm not gonna say, I wouldn't suggest, oh, you're getting ready to buy a house, download Credit Karma and go off of that. Like don't do that at all. So we have some additional questions that came up about the credit card transfers. So somebody says, Miss Rice says, Mama Rice says, what if I close my credit card and I'm just paying it off? If I transfer my balance to that 0 card, would that help my FICO score? So yes, that's a short answer. Whenever you do a balance transfer, it looks like you completely paid off one account, but you do open up another one. But at the end of the day, it looks like you completely paid off somebody else. So that's an instant boost once that hits your credit score? Good questions. Thank you for the feedback. All right, going back to the presentation. Trying to do this.
There we go.
All right, there we go. Getting the hang of it now. Next question is, so this was a question that came in on Instagram. What are the risks of real estate investing and what can be done to minimize or eliminate the risks?
Okay, so real estate investing and risk, just like with anything else, just like with any other business, there's tons of risk, which is why everyone doesn't do it. As far as minimizing or eliminating risk, I'm not sure if you can eliminate it, but you can minimize it by doing your due diligence. Getting referrals for contractors that you're working with, making sure that you understand what you're signing off on when you're doing deals, if you're buying an investment property, making sure that you're thorough with your tenants that you're working with to make sure that you get good tenants in your property that's going to take care of your property. All of these are things you can do to minimize risk, but none of it eliminates, because you can do everything under the sun and something that you do not expect will always come up. But there are some things you can do, like I say, just doing your due diligence and making sure that you are researching what you're doing before you just jump right into it to help minimize some of the mistakes. But everyone is going to experience some type of lumps in any type of investment.
Yeah, just to kind of add on that, so the biggest two risks would be, if we think back to the housing bubble of 2009. That turned away a lot of would-be real estate investors because people became underwater on their mortgages. So that basically means their property was worth less than they paid for it. So they were paying more for a house that had depreciated in value. Correct. So that's starting to kind of come around a little bit in some aspects. But property values are increasing. But anybody if you bought after 2009, you probably have equity in your home. But the other thing about it is, of course, personal financial risk. We see like now, there's like a financial crisis, lost wages. So that can affect. So it's also good if you want to minimize that risk, it's good to have some type of reserves. And even if you don't have reserves, it's good to probably just have some additional streams of income where you can at least
balance out some things if you need to. Right. And that was the reason for me initially even getting into real estate, is to have an additional stream of income, because having a job, at the end of the day, especially here in Georgia, you can be let go of a job at the drop of a dime without any good reason or anything. So having a job, it really is not security. No one has job security in Georgia. I tell people that all the time. So having real estate, having that additional source of income does help out to balance out with anything going on in the job market.
Yeah. And one of the other things about it is a lot of people will buy real estate and they become house poor. So what is house poor? House poor is you've spent $300,000 on a house, a big old house, and now you have to furnish it. And some people, they have different schools of thought. Some people think, they have to get all their furniture, everything needs to be in place. And it's others up front. And there's other schools of thought is like, hey, I'm gonna be here for a while. I might as well take my time adding stuff to my house. So I know all my friends and family who are watching this, they already know. When I bought my first property, it took a while for me to put everything, because you got to be very strategic. So once again, this is your investment. So it goes back to that comfort level. How much are you willing to spend up front?
And don't go into debt trying to impress other people. That's the main thing.
Don't keep it with the Joneses.
Whatever makes sense for you at the moment, do that what makes sense for you. But do not go into debt trying to impress other people, because it really does not matter at the end of the day. And when you get in trouble with that debt, only you have to deal with it, not the people you were trying to impress.
Okay. So I see some other questions coming into the chat. So we're going to work those down toward the bottom of this first section, just FYI. So the next question is, how do you secure funding?
So securing fundings, once again, there's different types of loans depending on what type of real estate you're trying to invest in. You can get an investment loan. Like I said, that's between 20-25% down. You can get a first-time home buyer's loan, which you can get with a FHA loan. That's a FHA 3.5% down payment. There's also loans for people that want to, buy a multi-unit property. it's called a 203K loan, where they will give you actual rehab money to build up your property while you're living in it, and then you can rent out the other rooms or the other units of that property, like if it's a duplex or something, and you can get loans for that as well. So it really just depends on what you're trying to accomplish, and all of that can be answered just by simply reaching out to your lenders, and they will let you know what options you have available to you.
That's the traditional route. So what about non-traditional?
Non-traditional route, hard money loans. Hard money loans are basically private loans that basically there's these groups that pool money together, and they loan them out to people for different reasons for real estate. So basically, one way a lot of people do house flipping, they get hard money loans because they're short-term loans. Normally they have very high interest rates, and they're short terms, normally 12 to 18-month loans that you go out and they give you the money to rehab the house, purchase the house. You have to put a down payment down, of course, but they give you the money to rehab the house, and then you have to pay it back. So the trick to it is that you have to pay it back within that short amount of time. And if anything happens, let's say like COVID, that could possibly stall out the market, and you can't unload the house like once it's renovated, or can't finish the renovations because of COVID or anything, you're on the hook for paying back that loan. And they take out, you're already paying high interest rates every month, and they also have access to your funds or either your other properties that you currently own. So those are very high risk loans, doing hard money loans. A lot of people do them because they are good if you know what you're doing with flipping. But they are very good options to have, but it's just very high risk.
Another sort of non-traditional avenue. So back to the hard money loans, real estate investment pool. So you get a group of friends together or family members. You all equally put money into the pool, and you all go after a property. It's an easy way to, have better terms. A lot of times these options are easy. It's easier to access capital that way. You're pulling from people people you see often, people you can trust, and you're not necessarily dealing with a bank on that aspect. On that front, another part is cash out refinancing. So if any current homeowners, any property owners out there now, if you currently own a property and you've been there for some time, or if you made some additions to it, and you have equity in it, you can do a cash out refinancing. So basically what that is you're pulling money out of that property, and you can use it toward an investment of another property. So this is one of the ways that most real estate investors kind of go after. They kind of just use those funds, as long as you're pouring that money into your next project, and you're making sure you get that return before you jump into that next project. That's what's really key.
Yeah.
You don't want to over leverage yourself. So leveraging yourself is basically saying you have all this kind of like outstanding balances or mortgages. So you've done a number of refinancing, and so that kind of snowballs that effect. So you don't want to get to a point where you're over leveraging. You have, we talk about debt to income. We'll get into that later, but yeah, that's that. So we get another question here that's kind of related. So if someone doesn't want to become a direct real estate investor, but instead they want a real estate investment trading, where do they start, and what are the top 3 things to look for in the REIT? So that's a really good question. Me personally, I can speak to that on some aspects. I invest in mutual funds. So most of the time, those mutual funds will be a combination of things like REITs and, different diversified streams or portfolios. I also invest in something called fundrise.com. So that's one way of I think that's probably one of the safest. Your returns aren't going to be that quick on Fundrise, but definitely educate yourself. I'll try to come back. So we'll try to do some
more research
on that one. That's a really good question.
Very good question.
Yeah, anything else to add on that?
Nope, I have to do research while I talk on that one.
Okay. All right. All right. Good question, Kristen. So here we go. We're just talking about this. So next question is, should we be focused on debt to income ratio?
I think most definitely you should be. That is one of the things that you need to be focused on even before you really start applying for pre-approvals, because that's the first thing that banks really look at to see if you can be approved for a property. So it's very important to get your debt to income ratio down to a certain percentage. I want to say, yeah, it's around 43% that they would like debt to income ratio to be at for you to get a pre-approval. So basically, make sure that you get as much debt paid down as possible, and make sure you get as much debt paid down as possible, and make sure that that you're financially ready. And that's the whole purpose of the debt to income ratio, is make sure that you're prepared to be able to cover that mortgage for the next 15, 30 years.
There's a good resource on nerdwallet.com. I highly recommend it to everybody. They can give you information about, different, we talked about balance transfers.
Mm-hmm.
You can go in there and you can research different credit card options that do that. They also have a nice debt to income ratio calculator, and you can actually put in the home value, your estimated down payment, and it'll let you know what your mortgage payments are and kind of tell you where you are within that range. So definitely do your research online. Of course, feel free to ask us any additional questions. This was a good question, but this is something that lenders look at. So it's really important, right? It's one of the top things. Yep. It's going to make or break whether or not they approve you for funding. So it's good to know this information up front. Good question. So the next question we have, so this is our part 2. So before we get into part 2, I'm going to go back up and answer. Trey asks, how would I go about determining the rent to charge for my property?
So there are a couple of different websites out there that can tell you what rents are going for in your neighborhood. One that I like to use is called Rentometer, RENTOMETER.com. You can go in there and plug in your address, and it will show you on a map what other properties in your area are currently renting for. And it really does, help give you some insight. It might not give you the exact number that you can rent for, but it helps to know what other people are renting for in the area for the house of your size with the bedrooms and baths. So that is one that I use kind of all the time, really, when I'm researching properties.
Of course, another good resource is if you do have a real estate agent or somebody you're working with, oftentimes they can give you comparables. So that's basically, they'll look at other properties within the vicinity of the subject property that you're looking for, and they can tell you, how much the average rent is within the area. And most of the times, it's something called fair market rent. So you can only charge up to that max, depending on what the area is. But of course, some people, work around that. So definitely keep in mind, if you're working with a real estate agent, that's one easy way, because they have access to the multiple listing service. So that's where all the properties are listed, and they can give you that information directly. Ms. Rice asks, can we define the term?
The REIT.
REIT. So REIT, I misspoke. I know I did. Real Estate Investment Trust. That's what it stands for. So most companies that own or finance income producing real estate across a range of different property sectors. So going back to when I was talking about Fundrise. So Fundrise has 2 different ways of avenues. So you can do debt. You can have a debt options, or you can have equity options. So debt means, you lend the money and you're expecting a return on that. Equity is you're putting the money up front to own part of whatever the property is going to be. So there's different options like that. We use these strategies as well. Actually, when we reached out for funding for some of our project, we had a similar type.
Yeah, with the hard money loans and hard money lenders, they did ask for different type of ratios to assess the project up front before they would approve it.
Good questions, though. So we'll get into, are there any more questions on this part? I'm just going to scroll up. Check the IG. Is there any questions in there? I think we got all this here.
Check IG.
All right.
We're good on IG.
All right, we're good on IG. All right, we're going to move into part 2 of the presentation. So we're still good on time here. All right, next part. So again, stay tuned to the end for a special presentation or a special offering. Next part is counter gentrification strategies. So
So what is counter-gentrification? Counter-gentrification is reversing the adverse effects of displacing communities.
So that means, so we already know what gentrification is, especially if if you're in any major city, with Atlanta being one example. We see how a lot of people are being displaced, period, and you see different communities moving in and displacing those who are already there. So that's just a quick and dirty. So the next question we have is, how can I be a part of counter gentrification? So for starters, you can commit to investing in your hometown or your community. That's really the biggest thing. If it's possible for you to stay put where you are, if you have any family members, any relatives who still live in areas that are subject to gentrification, whatever you can do to kind of hold on to that property, this is the time to do it.
Yep, especially if you have older members of your families that have properties in great areas, and everyone hates to think about it, but if they pass away, if no one doesn't take over the house or take claim of the house, it can easily fall into a place where an investor comes in and scoops it up, and it causes gentrification in the area, or an additional person to come in to have gentrification in the area. So it's very good to make sure that you keep in mind the different relatives that you have in different areas and parts of town, just making sure that you keep those properties in your families. It's very important to do that.
The next part is you can stop moving to the suburbs, especially if you already have property. You have property within the city limits. Hold on to it, period. Hold on to it, period.
Correct.
Next is you can ask relatives who still live in communities if they are underwater or if they have any property liens that need to be paid off. So oftentimes, I know a lot of our older, our senior relatives, they may or may not have, they may not even know they have tax liens or any things that would affect them from reselling or refinancing their homes. So it's often a good time while they're still alive to ask them the questions. Do your own research. Make sure the title of the home is free and clear. And again, these are things that you can research on, and all it takes is literally contacting the county clerk's office.
It's all online. It's all public. It's all public information. You can look up all this stuff online. If you have any questions once you find out anything, or even if you have any questions before you find out anything, there's a lot of different resources you can reach out to find out what's going on. If you happen to find out there's a tax lien on the house, call to the local, the local county clerk's office and find out why is there a tax lien, what needs to happen to get it removed. And just do as much as you can to help people out, because like you said, a lot of people, especially our older generations, they're not sure what's going on a lot of times when something happens, and they're just not properly informed.
And the last thing is, once again, if you do have any family members, any of that, the goal is to pay down or eliminate the mortgage if possible. If they're living in an area that's subject to gentrification, that means their property taxes are increasing at a rapid rate. So just imagine having to pay your fixed mortgage payment, and then on top of that, paying increase, year over year, you're paying more and more in property taxes. So again, the objective is to pay down that mortgage as much as possible. So all you have to do is worry about the property taxes. We got a good comment in here, so I'm just gonna read this one too. Kristen says, personally, one huge thing that drove gentrification where she was from reverse mortgages. She said older people took out reverse mortgages due to the age of the home, insurance costs increase, and upkeep or reno. So we're actually gonna get into that as well. She said that that exhausted the money. Now it's time. Now it's a home in foreclosure, and it's an insignificant need to repair. What strategies help someone like that? We're gonna get into that. Good question. Next part is how can multifamily properties be used?
So multifamily properties, you can buy a multifamily property, like I said earlier, and there are specific loans, a 203K loan that you could use to actually renovate a multi-property unit, and you would actually be able to rent out those other units and have help with getting the renovations done. So that is that is very huge, because a lot of times when investors buy properties, it's up to the investor to have the funds to make sure that the property's up to code and before they can rent it out to anyone. So it's very huge to be able to get one of those 203K loans. And multi-unit properties, it helps, because you're in control of who moves in and who moves out for the most part. Like you actually are, based off of how much, you put into it and what rents you're going to charge and what requirements you're going to charge. You have some control over, who stays in your neighborhood, which is huge.
The other part of that is, oftentimes if you're one of the older ranch style houses, for example, these are most of the time they're huge properties. Sometimes some of them have basements, some of them have, attics or just separate spaces with separate entrances. You can take advantage of house hacking. So what is house hacking? So house hacking is basically you're having rental income come in to pay off your mortgage. So we both kind of took advantage of this, back when Airbnb was a thing.
Right.
Definitely took advantage of having that short-term rental income as an additional stream of income to pay down, mortgages or any debt, period. But the goal for house hacking, so let's say maybe you currently live in a large property and you're able to rent out a room or just rent out different sections of the house. You have a basement with a separate door. This is essentially money you're sitting on top of. So all you have to do is just get up to speed and, people will definitely rent it out.
Yep, it was one of the best decisions I made. Josh put me on to the whole Airbnb thing. And one thing we've had the conversation multiple times, it was the easiest money to make at the time when it was very peak, when it was very good. It was just the easiest money because you would literally, have people, come in, stay at your house for a day and a half, and you would get paid a whole bunch of money for them to do that because, of how it's set up. So it was very, very easy money. There's plenty of opportunities to do stuff like that even now, but, it's easy money. You just have to be willing to do something different from the norm.
And these strategies are really, I would say they're more commonplace with other cultures. I think culturally, Black people we don't really, we like to have our own. We don't necessarily
want to share our living spaces.
Yep. But most communities often, most communities will live under one roof. Everybody's contributing to the household, and this kind of one thing to keep in mind. So this is how other cultures are doing it. So we really just want to make it less taboo within our community. There are avenues to be able to generate cash within your collective circle and to pay down mortgages quicker.
Yep.
Ian has a good comment he brought in. He says Atlanta zoning code is also being updated this year to allow for new accessory dwelling units built in some R5 and other zones that think of garage apartments. So you can rent them for about $800 a month for extra income. So thanks for that comment, Ian. So once again, some people can rent out their garages, as it looks like now. So even that little space between above garages, some houses have that space.
Yep.
But definitely get creative when it comes to that. So the next question is going back to what Kristen asked. How do you get out of reverse mortgage? So first off, for anybody who might not know it, a reverse mortgage is a loan. A homeowner who is 62 or older and they have considerable home equity, so they've been there for a while, they are actually allowed to borrow against the value of the home and receive the funds as a lump sum or a fixed monthly payment or a line of credit. So I know my grandmother, for example, she had a reverse mortgage. So, of course, as she was already retired, so she was basically getting paid a fixed income as year over year, monthly. So instead of money going out, money was coming in. Now, it's unlike a regular mortgage because it doesn't require the homeowner to make any loan payments. So that can be really attractive, for elderly populations. As people get older and they might not be making as much income, this is definitely attractive. But it can be extremely difficult to get out of these reverse mortgages. Because essentially what you're doing is you're letting the bank, the bank gives you money, the more essentially you lose ownership of the property you live in.
Yep.
So that's one way they're able to come and foreclose on most senior citizens' homes. They get to a point when they've exhausted how much money they have pulled out.
Yep.
And we see it time and time again. But the good news is it is possible to get out a reverse mortgage. Okay, so I hope we answered your question on that. Did you have anything to add on?
No, I don't have a lot of experience. I know you have more experience dealing with those than I do, but yeah, I don't have a lot of experience. But I just look at reverse mortgages as a part of predatory lending, if you ask me, because it's just not fair. Because it's like you're trying to basically weigh how long you're gonna live and how much you can pull out of this mortgage over that time. If you live longer than that, then they take your house, and that's horrible.
Yeah, and I mean, if you think about it, the average life expectancy has increased. So people are living a lot longer. So now it's even more of an incentive to be able, like, okay, if you're going to be here for some time, it just makes sense to kind of pay down the house. You really, I mean, to say you really don't own a house until you paid it all the way off. But
you still don't own a house at that point, because
right?
If you miss a property tax bill for a year, they're gonna take it. They don't care if you paid the house off or not. So you really effectively never really own a house in the United States.
That's a fact.
You never do.
That's a fact. That's a fact. But yeah, that goes back to at least paying down the mortgage. And so I would just tell anybody, if you have elderly parents, grandparents who are still living, try your hardest not to let them get into a reverse mortgage.
Yes,
because it's a slippery slope.
Yep, especially if the house is paid for. Do not do a reverse mortgage. I mean, really don't do it at all, but especially if a house is paid for. I mean, it just goes back to those conversations Josh were talking about earlier with some of your seniors in your family. If they need help maintaining certain parts of their house, see if you can pool together some family members and help them maintain their house so that they can stay in it, help them pay their property taxes, because they're on fixed income a lot of times, and because of things like gentrification, property taxes go up as an effect of that. So definitely, have those conversations and make sure that that you're doing as much as you can to try to take some of that burden off, because they've earned the right to own that house and be in it, and it's sad that they get taken advantage of.
So we have about 2 more questions, and so if you have any additional questions, feel free to pop them in the chat here. So the next question is, what are property tax liens?
Okay, so property tax liens is when a landowner or homeowner fails to pay the property taxes on their property. The city or county in which the property is located has the authority to place a lien on the property. So basically what we were just talking about with not paying property taxes on time or anything like that, the city or county that the property is in, they can come in and they can place a lien on the property. And if you don't pay that lien off within a certain amount of time, they have the right to sell your property to someone else. Normally it goes to investors who are sitting at the courthouse like sharks waiting for the next property lien to be past due, and they jump right on it. So it is, you have some more information on it?
Yeah. So yeah, I've definitely been personally affected on this on my childhood home and my grandparents' home. So I've seen it firsthand. We've even actually been at the Fulton County, of course, this is pre-COVID, the Fulton County courthouse on the steps. If you ever go out there, I think it's the first
Tuesday of every month.
It used to be the first Tuesday every month. If you get out there, there's literally a pool of investors, and they are all bidding for these properties, sometimes sight unseen, and they have a whole list. And these properties are going like that. So it's just like
it's an entire business.
It's an entire business. So it's like it doesn't even matter whatever that connection, that property was. This tax lien wasn't paid. The government wants their money. The bank wants their money. It is what it is after that.
And literally a lot of investors are able to get properties for $2,000-$3,000
dirt cheap
just to pay off the property tax lien. So that's the only thing that the government really wants at the end of the day is the property taxes paid. They will sell your property to someone else over $2,000-$3,000. Just that simple. And you have to get out.
You got to get out. So be mindful. Again, check with your older parents, your grandparents, any relatives, and just check on the title, check on their taxes, just have a conversation with them. How are you doing with your taxes? Is there anything you do? Because oftentimes they might not tell you.
Correct. Yep.
So definitely ask questions. So we're moving toward our last slide of this presentation. But we actually want everyone
to sign our petition. We started a petition here in Atlanta for the city of Atlanta, for seniors in the city of Atlanta, where we're basically trying to help a lot of them stay in their homes based off of a lot of the things that we talked about tonight: gentrification, tax liens, things like that. And primarily due to gentrification. A lot of gentrification has displaced a lot of our seniors in the city of Atlanta. And it's because the property values have gone up so much that they can't afford their property taxes due to someone coming in, renovating a house that was $100,000 and then renovating and selling for $400,000. Now the neighbor's house has a value of, comparable to what's been upgraded next door. So a lot of our seniors on fixed incomes, they cannot afford it. And a lot of them have been displaced. So we started a petition on change.org. And basically this petition, go up just a little bit. Mm-hmm. Basically on this petition, what we're proposing is that the city of Atlanta cap the taxes for the property taxes for senior citizens. Basically we're asking that, anyone 62 or older that has a primary residence here in the city of Atlanta that has been here for at least the last 10 years, that property taxes within those years, property taxes have increased within the past 5 years. We're basically proposing that they cap them for basically either the average rate of their property taxes over the last 5 years or the lowest rate within 5 years, or whichever is less. So, this is just something that we're doing as a part of our counter gentrification strategy, is trying to keep seniors in their homes. A lot of these seniors have been here for decades, and they're the reason that the city of Atlanta is the city that it is today. So I just think that it's an honorable thing to reach out to them, to help them out, to do more, to try to keep them in their homes.
Yep. So we're getting ready to wrap up, but as promised, we did say anybody who stayed to the end, we had something very special for you all. So before we get into that, are there any additional questions? Check the IG. Are we good on IG?
Let's see. We are good on IG.
We're good on IG. Are there any more questions in the chat? Okay. So now we want to share. So since everyone's been tuning in, we want to thank everybody. We invite everybody to follow us on Facebook, Instagram. Definitely check out our website is www.jjregroup.llc.com. We're on Facebook, Instagram. This presentation will be available on YouTube. So please, if you missed anything, you can follow up, you can share. And finally, thanks for watching. We want to share this little tad bit. So if you stay to the end of the presentation, we are offering, we have a cleaning service as well called Cleanliness. So that website is www.cleanlinessllc.com. If you type in the code by the block, you will get a free a la carte service with the purchase of a cleaning.
Yep. So just by the block, put it, and you can put the code and the address online too on the website when you're booking, and that will let us know that you attended this seminar with us, and it's just our way of showing appreciation. We really do appreciate all the support that we have been getting. It has been great. We have a lot of things coming down the pipeline with real estate, and we are just very excited to be on this journey and to take you on this journey with us.
So thank you all so much, and please continue to like, share. We appreciate all the support, all the love. We'll have, again, this video will be uploaded to our YouTube channel, and check it out later, and go ahead and check out what content we already have there. And we will likely be doing this again. So please
very soon
continue to send in your questions. We enjoyed the feedback, and that's all we got.
Yep. Thanks, everybody. See you later.